Good morning and welcome to the Killik & Co market update. Boris Johnson announced his roadmap for lifting lockdown on the 22nd of February. International flights will be allowed from the 17th of May and social restrictions will be completely lifted from the 21st of June at the earliest. The announcement led to a surge in holiday bookings and we've seen some fairly big reactions on the UK stock market. Companies that have been hard hit by lockdown have experienced share price gains, whereas companies that benefited from lockdown have experienced share price losses. We've got a couple of examples here. Shares in pub company JD Wetherspoon were up 8.45% on the day of the announcement, and shares in IAG, which owns British Airways, were up 7.45%, but shares in Ocado, which has been a real lockdown beneficiary, were down 6.17%. Other countries around the world have also been announcing their plans for lifting lockdowns, and therefore we've seen similar share price movements on global stock markets. It's been a good year for growth stocks, but a bad year for value stocks. Technology companies would go into that growth category and they've really benefited from lockdown, whereas in the value category we'd have stocks such as energy and financials that really haven't had a very good year. Over the last week, we've seen a move out of growth and into value. Some of this is due to the various announcements about lockdowns around the world easing, but it also relates to the expectations of rising inflation that we've mentioned in the last couple of videos. The role of central banks is to keep inflation steady, usually at a rate of around about 2%. If inflation rises, central banks will usually raise interest rates in order to bring that inflation back down. Therefore, over the last couple of weeks, because inflation expectations have been rising, markets have also been expecting higher interest rates, and they've been reacting to that. Higher interest rates can be bad news for growth stocks, particularly those that have high levels of debt, whereas financial stocks, for example, in the value category, would actually benefit from higher interest rates. The S&P 500 is a fairly growth-orientated index, especially in comparison to the FTSE 100. We've got lots of technology companies in the S&P 500, and the index has sold off quite heavily over the last week. Here's the chart showing the index over the last year. In the blue, we've got the index itself, and then we've got the 50-day moving average in the pink and the 200-day moving average in the green. As you can see, there have been several occasions over the last year when the index has come down to the 50-day moving average, but then it's bounced back again fairly quickly. Over the last week, it has come down to that level again, so we'll be watching very closely to see where it goes from here. Now, we've said that the S&P 500 is a fairly growth-orientated index, but that doesn't mean it doesn't contain some value constituents. So we've broken it down into its value and growth-orientated constituents, and we've shown them both separately on this chart here. So as you can see, the growth constituents have massively outperformed the value over the last year. However, over the last week, you can see that growth has really dropped off, whereas value has remained quite resilient. The chairman of the Federal Reserve, Jerome Powell, presented his latest views on monetary policy to Congress this week. As we've just talked about, markets have been fearful of interest rate rises recently, and Jerome Powell did his best to calm those fears. Here's the relevant comment from his statement. He said, "We expect that it will be appropriate to maintain the current accommodative target range of the federal funds rate until labour market conditions have reached levels consistent with the committee's assessments of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time." Essentially, he's reiterating previous comments that the Federal Reserve rate will keep interest rates low for the time being, even if inflation starts to rise. So let's wait and see if those comments have an impact on markets in terms of calming them. Moving on to have a look at next week, we've got results out from Prudential, Costco and Vonovia. That's it from us. Enjoy the weekend and we'll see you next Friday.